a little bit. Instead of looking outside at the gorgeous palm trees and blue sky, I kind of turned my computer around. Maybe the lighting's a little bit better on my face. I got the good old, there you go, good old whiteboard in the background. All right, cool. Hey, before we dive in, I really want to encourage everyone to listen to the most recent Endgame podcast with Grant Williams and Bill Fleckenstein. I've been listening to it all morning, and it's phenomenal. It's absolutely incredible. In fact, I put out on Twitter that if you've got to make a decision basically between watching my live stream today and that podcast, you should watch that podcast. Even I would admit to that. I'm no Lacey Hunt. That is for sure. Let me pull up a picture of it so you guys can see. Just go to iTunes. I saw a couple people on Twitter comment that it's not up on YouTube yet. But if you just check it out on iTunes, it's this, shoot, I don't know if you can see it there. It's Grant Williams' podcast that he does with Bill Fleckenstein called The Endgame. Whoops. Just had someone follow me on Twitter. And it's hard to get this thing straight. It's episode 6. I don't know if you guys can see that, but I think it just came out today with Dr. Lacey Hunt, and it's incredible. I think it's one of my favorite pieces of content this entire year, for sure. Lacey Hunt is just incredible. He goes into such great detail on the economic history and what happened in the 1700s and the 1800s, and people like Adam Smith that were writing that at that time, David Hume. And it's just so cool to take that and put it in and layer it over to what we're experiencing in the economy right now. On that note, I was doing a live stream with Lynn Alden last week for Rebel Capitalist Pro. And I guess now is a good time to plug Rebel Capitalist Pro. If you guys haven't checked out the online forum, the membership program I have with Lynn Alden and Chris McIntosh, definitely check it out today after you listen to Grant's podcast with Lacey Hunt. It's at georgegammon.com/pro. But in last week's live stream that I did for members with Lynn Alden, she was talking about a most recent report that she had, and she went back and looked at kind of the political narrative and what they are talking about. And it was like in ancient Greece around it was Athens, I believe. And when their government got too far in debt, it's very similar to the United States right now. And the debate between political groups was identical. She said that it felt like reading something today, such as we should have free college tuition, we should have free medical care, we should have austerity, we should lower taxes, we should do all. It was the exact same debate that we're having today in 2020. However many hundreds of years ago. It's just so cool that history, it doesn't repeat exactly, but it rhymes. And if we can be students of history and economic history, we can be far more prepared for what will come in the next few years. One thing I did today, this morning, actually, when I woke up, is I started reading some just little stories about the Spanish flu in 1918 and how long it lasted and what people were doing, especially in New York. They did the exact same things. It was wearing masks. They did lockdowns. They prevented people from going to church, to going to school, to go out and shopping. We're all humans, guys. We're all hardwired the same way. So the stuff we're doing today, we did it back in 1918. And I think that's a reason to be optimistic, because if you look at what happened, how severe it was in that period between the spring of 1918 and the summer of 1919, when it was kind of resolved because we got to a herd immunity. It was absolutely devastating. but the countermeasures, if you will, by governments were the exact same. Nothing's really changed. The thing that's changed now is that since we don't, or back then, we didn't really have a way of combating it or even treating it in the hospitals. And I think we didn't have social media. We didn't have all these things. So if I had to say, if anything's going to be slightly different, if we can get to herd immunity with this recent strain, or, whether you want to think it's fake, it's real, or it was done by the Chinese, wherever you want to go with that. The bottom line is, if we do have this virus, if it is similar to 1918, the difference would be, I think we'll get to herd immunity a lot. It'll take us a lot longer to get to herd immunity because people are aware that we're getting this data, good or bad, in real time, and people are taking precautionary measures, as an example. So I guess the upside is hopefully you have fewer deaths as a result. The downside is it takes a lot longer to get to herd immunity. So like always, it's a cost-benefit analysis. But anyway, study history, guys, and listen to the most recent podcast with Grant, Bill, and Dr. Lacey Hunt. Let me go right into today's questions. I'm at the oh my goodness, we had people submitting questions over the last 2 hours. Holy cow. Okay. Thank you very much, guys, for logging in that soon. It looks like the first question is from GPOG. At what price will you begin to sell precious metals? Well, gold, no price, because I just don't really hold gold to sell it. I don't know. Maybe it could get, I don't know. I don't know if I would sell gold. I'd have to think that one through. I'm sure there is potentially a scenario where I would sell gold, but I can't think of it off the top of my head. As far as silver, I'm actually thinking about doing a whiteboard video on it this week, because I know silver is a real hot topic, and I like to kind of address what's on most people's minds. I see that more as a speculation. So what I would be looking at there is the historic price of silver adjusted for inflation, and then I would try to somehow layer over the additional M2 money supply. And I know Snyder would get mad at me for saying that. I'm sorry, Jeff. I'm sorry. But I just kind of use it as somewhat of a gauge, because, well, I won't go into the reasons why. That gets into some real technical stuff when I start outlining how Jeff thinks about M2 money supply. So that would take me this entire live stream. So without going into that great detail, we'll just say that I think that there could be a relationship between silver and M2 money supply, or precious metals, that might not be there in other asset classes. So that's where I'd start. It's just, I always start with a chart going back as far as I can, adjusted for inflation, and just looking for highs and lows, and asking myself, like Jim Rogers has taught us in the interview I had with him, and it's the exact same thing that he taught his students at Columbia back in the late 80s, I believe, is when he was teaching at Columbia. And that's just to look at charts, historical charts, and see when you have anomalies, when you have prices just going parabolic or crashing, and just try to figure out what happened, what made it do that. And in my interview with Jim, he uses an example of the price of cotton back in the 1800s. And he says, you got to figure out what made cotton go from, I don't know if they measured it by a pound back. I'm not sure how what unit they used, but it was like 10 cents, or it was even under 10 cents. And within a matter of, like 2 or 3 months, it went to over $1.20, if my memory serves me right. And that, if you guys saw my video, it's actually worth the price. It's one of these old school charts. I wish I could throw it up on my screen here. I've actually got it on my desktop to always remind myself to think through things like Jim Rogers does. but the price literally went off the chart. And it's really funny, but that's what I do. And I'd look at, the last time that silver got, what would it max out at $50 in nominal terms? And I'd say, okay, what drove the price? How can I learn from that? And maybe going back to the 1980s, the early 1980s, I'm assuming it hit a high there as well. Asking myself what drove that price, and then what drove the crash when it's a commodity, any asset, silver, gold, whatever, it goes up and it definitely goes down. So what drove the bear market after you had that peak? And that's where I'd start my thinking process in trying to answer the question whether now it's getting expensive and therefore now I want to start selling. But there's not like a definitive price with precious metals. Like for me, there would be with real estate. Like with real estate, let's look at the opposite side of that question. When would I buy? And if in the United States, if I saw real estate prices get down to where they were in 2012, adjusted for inflation, I'd be a buyer. And I think your cash flows would be super cheap as well. I can almost guarantee you debt would be super cheap unless we got there through just inflation outpacing the nominal price gains in the overall housing stock in the United States. But assuming we got there through an asset deflation like we did in 2000, call it 8, 9, all the way to 2012 when it bottomed out, then most likely you're going to see low interest rates. So you get cheap debt, the cash flow is going to be cheap, and the underlying asset itself would be cheap. A couple of people today asked me on Twitter about how I factor in the lower interest rates, therefore lower mortgage payments, with the fact that housing prices are now even higher than they were in 2006. And my response to that was basically, I don't factor that in, because it doesn't tell me anything about whether it's historically expensive or cheap. It just tells me whether it's more affordable right now, but that doesn't really do anything for me. I use the example back and forth on Twitter with the Q8 stock market. Again, this is something that I learned from Jim Rogers, but the Q8 stock market in the late 1970s, and I believe into 1980-81, just had a parabolic bubble, very similar to like the tulip bubble, or all bubbles kind of look the same. And what they were doing is they were allowing people to buy stock with post-dated checks. So you could have that exact same argument then. I could say, well, the Q80 stock market right now in 1980 is wildly overpriced. It's super, super expensive historically. And then you could say, well, are you factoring in that people can buy with post-dated checks? No. that doesn't change the fact of it being expensive. It just means that people have access to a lot more purchasing power that's totally unsustainable. And to me, it's the exact same thing with mortgage rates right now. I mean, yeah, we could have low mortgage rates for the next 5 years or 10 years or whatever, but are those mortgage rates sustainable? And by the way, if we have low mortgage rates for the next 10 years, you got to ask yourself the question, what does the economy look like, right? People just think, excuse me, people just think that the economy would just stay the same, but oh my gosh, we just have these 2% rates forever. And if we have 2% mortgage rates forever, then the affordability doesn't change. So housing's cheap. And they did these mental gymnastics to come to the conclusion that makes them sleep well at night. That's really the bottom line. It's that cognitive dissonance or whatever, in my opinion. But the bottom line is you have to look at what the economy looks like if we have 3% mortgage rates for the next 10 years. And what I mean by that is the economy would be bad times. It would be in dire straits, and therefore you have sustained unemployment. You wouldn't have the Fed wouldn't have figured out a transfer mechanism, or the government, to increase the rate of inflation. Therefore, you've got I don't know if you want to call it a 1930s type of depression, if you want to use something as an analogy. And therefore, do housing prices really go up? Does that mean that they're cheap right now? I don't think so. Anyway, I just try to keep it as simple as possible. Okay, on to the next question. That's enough of a tangent there. All right, let's see here. Waiting, hurry up. Time is money. Yeah. Okay. What if the TGA was used for productive lending? This is actually a good question. Prepare for another tangent, guys. Prepare for another tangent. But I think this tangent will deliver a lot of value, because it's something that I was also thinking about doing, or it's another topic I was thinking about using for a whiteboard video. So let me try to address this as concisely as possible. But what if the TGA was used for productive lending to help entrepreneurs and small businesses at a low or no interest rate? It would create jobs in the real sector, and government could get the tax. Okay. On paper, yes, Mr. Moss 786, you are correct. My concern is that we are making the assumption, and I would say the inaccurate assumption, that the business environment in the United States currently is similar to what it was, let's say, 10 years ago, before I retired. And I'd take it a step further back. And we even say that 10 years ago, we assumed that the business environment was consistent with where it was in the 1990s, or maybe the 1980s, something like that. We don't really, it's almost like Henry Hazlitt. We're not considering the unseen. And when the government layers on all these additional regulations annually, we don't really see them, because it doesn't affect what we're doing directly, unless we are an entrepreneur that is in that business. But we do know that regulations are increasing. We do know that government is a larger and larger percentage of GDP. Therefore, if government is a larger percentage of GDP, I think, I wouldn't say by definition, but it would be hard to come to a world where, as the government spending of GDP went from 20% to 30% to 40% to 50%. I mean, take it to its logical conclusion, right? If government spending was 100% of GDP, what would the business environment be like? Not too good. It would be communist Russia. So I think it's safe to assume that there is definitely a correlation between the amount of government spending as a percentage of GDP and the lack of business flexibility you have. So yeah, if we had a free market, I would say that that's a good idea. I don't know if it's a good idea, because then you also have to assume that the transfer mechanism that the government is using to deliver those loans to entrepreneurs would be efficient. And that's a big leap right there. I think that's one of the biggest things that people that argue for like a wealth tax, I think that's one of the biggest things they miss, is they assume that the government can, number one, even transfer the wealth, and number two, they do it well, and number three, they won't squander it. And we know that, I don't know that I know this definitively, I can't show you a chart on it, but I think it's pretty safe to assume, and I think most people on the live stream right now would agree, that if the government takes $1 from Jeff Bezos, let's say, by the time it gets to the average Joe and Jane on the street, what is it? 5 cents, 10 cents at the very most. And it's probably not going to the average Joe and Jane on the street. It's probably going to Jamie Dimon. It's probably going to XYZ corporate person. It's the Cantillon effect. It's the people that are closest to the government. It's the cronies. It's the crony capitalists. They're the ones that are getting the 95 cents, if not more, of that dollar that was taken from Jeff Bezos. And then you have to say, how do you know that that dollar that is taken from Jeff Bezos or whomever, I don't care, just plug in anyone's name there. How do you know that that dollar of taxes is actually going to be spent or with the intention of helping the middle class? Why wouldn't it be spent on another war? Why wouldn't it be spent on more TSA? Why wouldn't it be spent on more military police, making sure that you don't leave your house because of COVID? You see, people, they argue for stuff like this, but they forget that between point A and point B stands the government. And it's going to be wasted. And so, but my main point is that I think there was an argument for government spending being productive, but now the argument is dwindling because of the increased regulations and constrictions on businesses being able to compete with one another and to have this creative destruction, the Schumpeter, hopefully I'm pronouncing that right, creative destruction that, by the way, Dr. Lacey Hunt discusses with Bill and Grant on the podcast. So that's what I'd consider with your hypothesis. And guys, when you're doing the question, make sure you start with the word question, please. Yeah, it takes me a little time to find him because I really appreciate you guys being so active in the chat. It's really super cool that you guys are going back and forth, but unfortunately it takes, oh, here we go. Here's a question. What is your view on emerging economies during this turmoil, especially for countries like India? What are the opportunities that may exist in such markets? I haven't looked into India that much, Sujit, and I think long term, I would see some tailwind. Shorter term, I think it's anybody's guess. What I will say is, if you look at the study of the CAPE ratio, and Meb Faber on his podcast, I know, looks at this quite extensively, where once a country or a stock market, excuse me, gets to a certain level, the future projected returns diminish. And so there's almost like an interesting kind of basic strategy to selling markets when they get frothy as far as the CAPE ratio, and buying markets when they're cheap. Goes back to buying cheap, selling expensive type thing. And so I would look at India. But as far as emerging economies in general, I think that it's a timing issue. I mean, 2-3 years, who knows? Especially if we have a big dollar spike like Brent Johnson is talking about, which I still think is in the cards. I know the Dixie's at 92 handle or something like that, but I still think it's in the cards. It could be. I'm not saying it's a certainty. I'm just saying that the probability is definitely above zero. That's for sure. So there could be some more pain there for these emerging markets that have a lot of dollar-denominated debt. So, but long term, I think 5-10 years, I would be more bullish on the emerging economies. I think I would agree with Chris McIntosh, my other partner in Rebel Capitalist Pro. He sees a lot of the capital moving from these Western developed economies that are heavily in debt, and honestly moving in a direction of more Marxist policies. I'm not saying they're going to be communist Russia, but they're moving in that direction. The narrative is far more friendly towards a Marxist type of approach than it was like when I was growing up. That's for sure. And so I like countries, and I think it's as humans, we have the tendency to take a snapshot of what a country looks like right now and just extrapolate that forward indefinitely into the future. But that would have been a big mistake. And Jim Rogers reminds us of that as well. He says, look at any country, 10, 15 years ago. And very rarely is it similar to how it is today, or a lot of times there's significant changes. Singapore would be a fantastic example of that. China would be another example. And I don't, I think that you should look for countries where they're trending in a more, they're trending in a way that's more friendly to capital and entrepreneurs and more business friendly. And that's definitely not the direction we're going in the United States. And it's not the direction they're going in Europe. I can't speak to Japan too much, but it's just more government spending there too. So I would, as far as just broad macro, I would be more bullish on emerging economies that were putting or implementing a foundation and a structure that's going to be, or hopefully be, more free market, more capitalist moving forward. And I'd start to be more bearish long term on economies that were moving more towards Marxism. Not that they go full on communist, but they're being much more friendly to those concepts. Okay, Gary is asking, is it unreasonable to see the AGAU ratio to computers to 15 to 1 in the next 5 years, given the scarcity of physical silver available for retail delivery? I don't have an answer for that, Gary. What I'd suggest is I am interviewing a gold and resource specialist tomorrow for the Rebel Capitalist show, and we should have that interview. I'm trying to think through this. Yeah, that should be up tomorrow night. So 9 p.m. Eastern time. Look for that. And I think you're going to get a lot more insights on that from someone who's an expert. I'm by no means an expert in gold. I just take the simplest, or silver. I just take the simplest approach. I can't, especially with gold. You guys know that. I don't even look at the price. I just buy it. So yeah, I'm not one who could give you some advice when you kind of look at the minutia there. So definitely tune into that tomorrow night, Monday, 9 p.m. Eastern. That'll be live on the channel. Question, what's wrong with Robinhood? That's a pretty good question. So the thing I don't like about Robinhood is that they sell the trade flow to whomever wants to buy it. So what happens is the real pros, they buy that trade flow, and I'm talking about the high frequency traders. So if someone in Robinhood, let's say, is buying a share of Tesla, before the transaction can even occur, I mean, we're talking nanoseconds, attoseconds, and it goes to the trading firm, whatever, and they front run it. And so you got to listen, there's no free lunch. So if you've got this trading platform that's free and free this feature and free that feature, and you're like, oh my gosh, this trading platform is so cool. They really are looking out for the average Joe and Jane. They're looking out for the little guy just like me. Yeah, right. It just doesn't work that way. It goes back to the way that I look at property managers, because that's so important in real estate investing. And often when I look at property managers for a specific area, I'll actually go with the most expensive one. And there's more to it than that, but it often ends up being the most expensive because I know they're the ones that will screw me the least, theoretically, because they don't need to screw me in order to make money. Where I would say Robinhood needs to screw you in order to make money. That's the simplest way I can put it. And I don't even need a whiteboard to explain that one. So that's why I don't like Robinhood. Okay. Okay, Emmett. Oh shoot, Emmett. Sorry, buddy. I had your question and the thing jumped on me. Oh, here we go. Emmett asks, how likely is it that companies like Hertz will recover its old stock price after coming out of reconstruction? I mean, how likely is it? Uh, I don't. I'd have to think that through, Emmett. How likely is it? I mean, just right off the top of my head, I can't give you a well. I would say it's a 30% chance that it does X, Y, Z. I mean, especially now that we've got the Fed so involved. I mean, they're buying junk debt, as everyone knows. I mean, at what point will they start buying equities? I'm actually have been going back and forth with Michael Green, who is just a flat out genius. He has done quite a bit of content for Real Vision and with Grant on his Endgame podcast and several others. And he has he's studied passive investing quite extensively, and he really lays out a quite strong argument for. And I won't explain this because it's very difficult to explain, but that's why I was going to do a whiteboard video on it. But the stock market actually goes to zero, literally zero. And he's not saying this isn't like a tinfoil hat. This isn't Alex Jones, although I think Alex Jones is a pretty entertaining guy. I think he's fun to listen to. But regardless, but it's not just someone that's throwing it out there. Oh, the stock market's going to zero. It's not that. It's there's like using mathematics, using physics, using the understanding of how the market is structured and the participants in the market, how it could just basically go no bid. And I'll be outlining that. So my point is there's so many factors. It's very difficult, Emmett, because back in the good old days, the stock market was a reflection of the economy. In fact, I heard my buddy Eric Townsend, talk about this with Jim Bianco on Thursday night's episode of Macro Voices, where like I was saying, in the old days, the stock market was a reflection of the economy, and therefore, when the stock market would increase, the price signal for investors would be that okay, the market, quote unquote, sees the economy improving, because generally, when the stock market would go up, that's because it sees the economy doing better and better in the future, and the stock market is kind of front running the economy, because there was a relationship there, obviously, because the stock market was based on the profits of real businesses. Oh, imagine that. What crazy times that must have been. So now it's not the case. I would argue that there's almost an inverse relationship between the stock market and how well the real economy is doing in the United States. So again, normally, I think you could draw a semi-reasonable conclusion, but if you can right now, I'm not the guy to do it, Emmett. And there's too many cross currents. But it just goes back to the question. I mean, you're thinking about buying it. I'm assuming, or we wouldn't be asking the question. Is it cheap? Is it cheap? Based on their current earnings, what's going on with their chapter, I'm assuming chapter 11. Is it cheap? Is it expensive? And it's most likely the proverbial cigar butt. So I don't know if that's a buy or not. But I would be careful with that one, to say the least. Oh no. A question is shooting calls that will expire out of the money an easy way to make money? No, there's no easy ways to make money. Uh, unless it cash flows, I think that's an easy way to make money. If you can buy a piece of real estate, you know what's interesting, guys. As most of you know, I'm on the island of St. Bart's here with my good buddy Hugh Hendry, who is just such an awesome dude and great guy to talk about with everything. Really, he's a really nice guy, but he's just a genius when it comes to macro. But I was at a birthday party for his wife the other day, and a lot of the people there were kind of in finance, and one person in particular was a very well-known hedge fund individual, and I won't name names or anything, but been on CNBC, all that stuff. And we were talking, and his conclusion was, listen, even, he doesn't really deal with it too much, but he's like, real estate, it always goes back to real estate. Historically, that's just the best way to grow your wealth long term. And I'm not saying that you should go into the United States right now and just buy a house, just regardless, because I just posted a tweet with a chart that just looks horrific for the U.S. market as far as being overbought and expensive relative to real incomes. But it's just something to kind of, it's a seed to plant in your mind, and just to put that on a watch list and say, I like long-term, I like U.S. real estate. I just don't like it at today's price. So then asking yourself, what price do you like it? And then if you like it, like I do, most around the 2012 lows adjusted for inflation, because you see that historic trend line going back to 1900, just put that down on your list and just wait for it to get there. And if it doesn't get there, don't buy it. But if it does get there, you're going to be ready to pull the trigger. And another thing I'd suggest with real estate is I've put it out on Twitter the other day that I'm thinking about going to Dubai next month to not buy anything, but to start kicking tires and looking at the market, because it's gone down and it is super cheap. But what I wouldn't go in there and just start buying because of a chart. I mean, that's where I start, but you have to look at the cost of construction. And if you can buy under the cost of construction, and you can buy with positive cash flow, solid cash flow, 1% RV ratio, you got very little downside. So and I'm not saying that's an easy way to make money, going back to your original question, Costas, but I'm saying that I think that's a strategy that's most prudent. And I would hope that would be a part of everyone's portfolio. Maybe not now. I'm not saying now is the time to do it, but long term, trying to move in that direction. And I'm not saying it should be the majority of your portfolio, but I think everyone should think about it. And to be super clear, I'm not talking about real estate in Dubai necessarily. I'm just talking about cash flowing real estate, rental properties. Okay, here's Patrick asks, your portfolio is 10% gold, 10% speculation, 80% stuff that pays you to own it. You consider all stocks you talked about so far as speculation. Can you talk about the dividend stocks? The stocks that I have that are dividend paying are stocks that I bought back in, I want to say 2013, maybe 2012. No, I think it was 2013. And that was in Cyprus. I bought a bunch of when the market crashed there, went down by like 99%. I bought a bunch of stock. Not a bunch. But for me at the time was a bunch, because I never really had owned too many stocks before that. And I'd tinkered around with trading in early 2000s when I was playing a lot of blackjack. But that was really just to kind of learn how it works and to train my mind. It wasn't really to make money or anything. So anyway, so that was 2013. I've never sold them. I still have them. And I literally look at the price like once every 2 years. Last time I looked at it, I had made like my investment went up like 8 times, and the dividend went from 10% up to 30% on my cost basis. So I was like, woohoo, this is good. This investment stuff is easy. As far as the other stocks, I am in March, I bought the oil producers. I bought Shell. I bought Chevron. I think I might have bought Exxon as well. Just kind of mix it up a little bit. And then mostly Shell, though. And then I bought coal. I bought coal, the ETF, which I know Chris would be mad at me for buying the ETF. I need to sell it and diversify and transition into just specific companies, which I just haven't had the time to do it. So what else did I buy? I know there's a couple more in there that I bought in March, but I don't recall. So I'd have to look at my little portfolio thing. But that's what I'm doing. I mean, right now, I think that there's some interesting opportunities outside of the United States. Lynn and I have discussed that extensively on with our live streams on Rebel Capitalist Pro. But as far as my personal stuff that I bought, that's about it. I still have a ton of my portfolio, as far as that 80% in real estate, as you can probably tell. A lot of it, a bit of it in the United States, but a lot of it in Colombia. That's where I was getting much higher yields than the United States. But I'm still looking to deploy that. One thing, Puerto Rico has gone down quite a bit as well. As far as the real estate, if things were opened up right now, I would go back to Puerto Rico and start kicking tires there, because it's like the United States in the sense that you're buying real estate that's denominated in dollars. So if your expenses are denominated in dollars, that's really important. You're taking quite a bit of risk if all your expenses are denominated in dollars, let's say, and you buy a peso denominated asset. That's why I always suggest people starting there. Now, I'm not saying that you shouldn't diversify your currency risk, but you should be cognizant of those expenses. So if your expenses, let's say, are in dollars, I wouldn't have more than maybe 30 or 40% of your portfolio in assets that are denominated in a different currency. So Puerto Rico is interesting in the sense that it's a dollar denominated asset, but it's cheap, or it's getting cheap. I'm not going to say it's cheap right now, but it's getting cheap. It's going in the right direction. It's going this way, which I like. I don't like this way. I like this way. So it's going in the direction I like, which is down. And there are some properties that I've actually looked at online. I haven't looked at them face to face, where you can get a 1% RV ratio. So I like that. And long term, I do like the fact that Puerto Rico has Act 20 and 22, not just for myself personally, but I think a lot of people are going to be moving there in the future because of tax rates increasing substantially in the United States. And I think that as the business climate becomes more and more unfriendly and more cronyism, more corporatism, higher taxes, I think people are going to look for alternatives. And I think Puerto Rico could be a long-term beneficiary. So not that I would buy for that reason. Remember, it always goes back to cheap and expensive. But if I could, and another thing I'm thinking too, guys, with real estate is once you get good, you know how to negotiate. So just because the listed price is $200,000 doesn't mean you buy it for $200,000. It means you can start looking around and find a motivated seller. And if you can find a motivated seller, and if you know what you're doing, if you know how to negotiate, maybe you get it for 150. You never know. And that's what I really like about real estate. If you're buying a stock and it's trading at $30 a share, you're not going to be able to find someone that sells it to you for 15 or gold or Bitcoin or anything. The market's too efficient. But with real estate, it's super inefficient. So if something's trading at 200, you might be able to get it for 150. You never know. And that's where having an expertise really comes in. And the more efficient, or excuse me, the more inefficient the market is, the more that benefits the people who really know what they're doing, and the more it hurts the noobs and the people who really have no clue. And so, like Colombia, as an example, is wildly inefficient. And I would say Puerto Rico is somewhere in between the United States and Colombia. So it offers a huge opportunity there. So maybe, I mean, if that $200,000 property is giving you a 1% RV ratio and is under the cost of construction, and you can go in and because of your negotiating skills, you can buy it for 150, a dollar denominated asset. That seems pretty good to me. So I'll be keeping you guys posted. Obviously, I tell you guys everything I do on these live streams. So stay tuned for that in the next few months. Dr. Leah asks what commodities are cheap right now and might be a place in. I think pretty much all commodities are cheap right now. I don't know of one that's super expensive, Leah. I know listening to Grant's podcast with Jim Grant the other day, Jim Grant was talking about how commodities relative to financial assets are at a 120-year low going back to 1900. So I think that's pretty darn cheap when you use that metric. And the problem is, how do you play commodities? Because you don't want to mess with the futures. At least for the average Joes like me, I wouldn't really suggest messing with futures too much. And you don't want to mess with an ETF who tries to track the price through futures, because then you're dealing with contango, and you probably have a negative carry there, or you're dealing with backwardation, where you may have a positive carry, but it gets more complex. For people who are pretty good or sophisticated, then you definitely want to maybe look at options, or I would tell you to check out Patrick Ceresna with Macro Voices. He's one of the best in the business there. He's someone that I always listen to. And even when I have a question, I'll email him or text him real quick. He's kind of my go-to source for that type of speculation or hedging. But the bottom line is, I think the easiest way to play that for average people like myself would be just to buy the producers. So like with commodities, with oil, when it was at -40 a barrel, I'm not going to buy a barrel of oil and put it in my backyard, but you might want to consider buying a Chevron or something like that. With the food, as far as agriculture, I know Chris McIntosh is bullish on some soil companies, maybe fertilizer. I'd probably start there. Oh, Mike, yeah, this is a good question, Mike. Should I pull equity from my house to purchase a rental property? It looks like your house is in BC. I think that's a pretty good strategy, Mike. And if you know what you're doing, and you're Canadian, so it's super easy for you to buy in the States. And it's not that a lot of people get confused here. Yes, the United States in aggregate total is in a housing bubble, 100%. And it's not cheap, it's super expensive. But for strictly speaking, a rental property, if you can buy the cash flow cheap, because when you're dealing with real estate, you're dealing with three things. You're dealing with debt, you're dealing with cash flow, and you're dealing with the underlying asset. So if you can get, and even if I was bearish on real estate, I would prefer to have my equity in a property where the downside, even if it was in a big bubble, the downside was 20% compared to 80, comparing BC to a linear market like maybe a Little Rock, Arkansas. And also, too, someone was asking me on a live stream with Rebel Capitals Pro about the fact that they couldn't use a 30-year fixed rate loan in Canada, because that's a product that's pretty much exclusive to the United States, because we subsidize it through the taxpayer, which most people don't know. That's what Fannie and Freddie is doing. But that's not a market product. So I think what you could do maybe is set up an LOC on your equity in Canada, so a line of credit against your equity, And then when you find a good deal, and if you know what you're doing, great. I would stick with a linear market in the United States, kick tires, be patient, maybe let the market come to you a little bit. And but maybe you can find that motivated seller, and maybe you can buy today for a 2012 price. You never know. Or maybe you can get some great cash flow in a great neighborhood. You use the market inefficiency to your advantage. If you know what you're doing, check that out. If you don't, I would suggest going to my buddy's website, Jason Hartman, who's a good friend that I trust a lot, and he'll help you out for free. I mean, one of his advice, even if you don't buy any of his the properties that he's working with his network, they'll help you out for free. And you can see on his website what markets he's in, and that's kind of where I'd start, because you know he's already done the due diligence for you. And then I'd take the line of credit maybe and buy the asset in the United States with the line of credit, and then I'd term out so now that you would have that line of credit, right, against your equity, and then you're basically buying the house in the United States and paying for it in full. You own it 100%. And then what I'd do is I'd go to the bank in the United States and I'd cash out refi for as much as I could, and then I'd term it out over 30 years, and then I'd fix in that rate, or I'd fix that interest rate, and then I'd take the money from that cash out refi and I'd pay off my line of credit. So that's how you could basically leverage your equity in Canada with a 30-year fixed rate debt that has a lot less downside. Oh, I saw another question in there about Houston. I was actually going to ask Art Berman. I was going to text Art and ask him about that. 51 minutes. Okay, I got to make sure I'm paying attention to that. I can't find the question about Houston real estate. That was a good one. All right, well, let me... Yeah, Mike asks if an RV ratio is compared to a 10-year treasury, or yeah, I mean, you could say an RV ratio is on anything. It's just how much a month are you getting, or how much annually, I guess, you're getting. With real estate, we just do month, and really that's kind of a Hartman thing. I borrowed that from him. I don't think most people, in fact, other real estate investor people might look at RV and have a different definition for it, the RV ratio. But the way I look at it, and the way Hartman looks at it, is just the amount of gross rent you're getting per month based on the value of the house. And so, yeah, I mean, you could do the same type of thing with a 10-year, although you're getting like 50 basis points. So at what point is a yield not a yield? But so, yeah, you could use the math for anything that throws off cash. I'm trying to find, so this is a good question here. I don't know if I could answer it on this live stream. The BIS, my research tells me they are the ones who control the world's central bank. Yeah, I don't know. Basel III agreed upon by the entire world. PM's revaluation on the horizon. Thoughts on the BIS? Yeah, I haven't done too much research on them. I mean, obviously, I don't like the World Economic Forum that much. I don't like Klaus and his cronies, if you saw that video. But I haven't looked into the BIS. I really don't like any tops-down organization. I mean, whether it's the Fed, whether it's a federal government, I like it. I see a place, but I like it to be very small, and I like them to serve the people. I don't like them to be the master over people. And if you look at our central planners today, we don't run them, they run us. They think that they're the masters over the little guy and gal. And so whether it's the BIS, whether it's the Fed, the IMF, the World Bank, the World Economic Forum, it's just, It's just these central planners, and I don't like any of them. So Dominique is asking, did you see the New York Times article from Minneapolis Fed president advocating super strict lockdowns, ominous sign for preparing for banking crisis? See, the banking crisis, that's a tough puzzle to solve because you've got so many headwinds, but then you've got 3.5 trillion in excess reserves. I mean, I don't know that the probability is high that you're going to have a banking crisis centered in the United States. Doesn't mean that you can't have a European banking crisis that has systemic risks and brings down the banking system here as well. Their balance sheets are just are too tough to figure out when you're considering derivatives and you're considering just the dollar funding markets, the euro dollar market, all these things that Jeff Snyder talks about all the time. But I don't know that, the general's always fighting the last war. And I would be surprised if we had a banking crisis similar to what we had in 2008, in 2009. It might be a knock-on effect, but I don't know that that's going to be the catalyst, that's going to be at the center of whatever happens next. I would guess that it wouldn't be, because generally when we have a black swan event or whenever you have this massive crash, it typically comes out of right field. It's not usually the thing that everyone is talking about. And that's why I don't know that we have a real estate crash, more so just a gradual grinding lower of real estate prices, maybe not even in nominal terms, but just in real terms. Because if we had a big real estate crash, it's exactly like 2008. I mean, everyone's talking about that. Everyone's expecting it. So it's almost by definition, if everyone's expecting it, it's not going to happen. And I would, how many people right now are expecting a stock market crash? Or how many people are expecting a blow off top? It's like 50-50, right? Whenever I see like 50-50 debate, I'm pretty much, I don't really have a strong conviction one way or the other. Whenever I have a strong conviction on something is when 99% of the people are on one side of the boat. Then I like to go to the other side, and I have a pretty strong conviction. So like if 99% of everyone, I'm talking about talking heads, I'm talking about newspapers, CNBC, your friends, your Facebook friends, if everyone was talking about inflation as an example, I would be, I don't know, or maybe I need to second guess that stagflation call that I've been making. It's just if everyone is on one side. And so if everyone is talking about housing prices crash, or if we're even 50-50, I get hesitant. So now it's not that I don't think about it. I try to kind of game theorize it, but I wouldn't have a strong conviction one way or the other. Okay, guys, we'll do one more question. Yeah, stay curious. That's a good question. Keith Giroux. And if you guys haven't looked at Keith Giroux's work, he is the real estate analyst for MarketWatch, I believe. I've used his research in some of my videos. He mentions that the banks were pulling homes off the LA market in 2012 to increase prices. Is this true? And could they do this again if massive foreclosures happen? Yeah, but I think the Fed might be the bank that's doing that and taking them onto their balance sheet. But yeah, so Keith, his hypothesis was the banks that had these loans still on their books. Remember that most of them just sold them to Fannie and Freddie. But there were some lending institutions that kept these residential loans on their balance sheet. And for those, they just stopped foreclosing on them. And not because they're nice, but they just wanted the market to recover so when they sold, they could recoup 100 cents on the dollar. Or excuse me, when they foreclosed on the person who wasn't paying, and then they sold the property back in the market, they'd be able to recoup 100 cents on the dollar. And the reason they've had to hold on to these things so long, he said, well, my gosh, the market's gone way up. And yeah, but for a bank to foreclose and then to sell in the open market, it's not like if they lent $100,000, they can sell it for $100,000 and recoup all their costs. They have, actually, it's quite substantially higher. They have to get like $150,000 for that house in order to recoup 100 cents on the dollar, because they've got to remodel it. They've got transaction fees. They've got legal fees. They've got all these things that add up that most people really don't understand. So it would make logical sense to me. I mean, if I was a bank, I would have done that. I would have definitely, because see, for the banks too, it really isn't affecting their balance sheet capacity back then, because the Fed was doing quantitative easing. So if the Fed's doing QE and you got a lot more liquidity and you got super cheap reserves, even back when we had reserve requirements, which we don't have now, but even back in the good old days when we had reserve requirements, I don't know that would have restricted. Obviously, you'd have to look at it on a bank by bank basis, but I think there's a good argument for the Fed giving them enough balance sheet capacity to where they wouldn't be required to send to create additional loans. And so why sell? Why sell? You've got some upkeep, some maintenance costs. You got to pay the property taxes, maybe. But yeah, I mean, I think it's a rational conclusion. So could it happen again? I'm sure it could. And I would argue that maybe a lot of these homes haven't even been sold back into the market. Therefore, the supply constriction that we're seeing might not be due to the fact that people aren't selling, but maybe banks aren't selling the assets they have on their balance sheet going all the way back to 2008, 2009. And not just for, the market bottom in 2012. So they could have assets on their balance sheet going back to 2011, 2012 that they still may be hanging on to. And also another piece of the puzzle that people don't consider is all the private equity funds and hedge fund guys that purchased back in 2012, 2013, 2014, and that those people aren't selling. So if you have a larger percentage of the housing stock that is that are considered rental properties as opposed to owner-occupant properties, then when it's time to, when a lot of people would be selling and creating additional supply, you have these investors and hedge funds that aren't selling, and therefore you have less supply hitting the market. And I don't think anyone really talks about that. And if you look at the percentages of homes that were purchased through 2011 to 2014, call it, by these massive pools of capital, I mean, it's huge percentages of places like Vegas, like Atlanta, Georgia, and others. And I don't think that anyone is really talking about that, especially the people that argue on that have that bullish argument for the real estate market going up because of a supply constriction. And they never tell you that the cure for high prices are high prices. That's something that no one really talks about either. But yeah, check into Keith's work. I would actually love to get him on the Rebel Capitalist show. I should reach out to him sometime soon. But I think he brings up some interesting points that we could see play out in the market over the next year, or maybe the next couple years. Okay, guys, I appreciate you being on the live stream today. Let's see. I'm going to do some shout outs for everyone that was here until the end. We've got Marvin, Andrew, BC in the Matrix, Ricardo, Bruno, Sujit, Roy. Thanks, Sujit. Eric, Jim, Total Recall, Acrobat Mapping, Dickie Dunn, Frank Me, Christopher Hill, Arthur. Thank you. Arthur's always here. Good to see you. And Arthur's always in the chat for Rebel Capitalist Pro too. So thank you for being there too, Arthur. I know you're always very active in the streams, and I appreciate the engagement and the time that you take to do that. Greg, thank you. Eliza, Caleb, SJ, Rexman. Okay, guys, thank you very much for being here. Make sure you check out Rebel Capitalist Pro. You guys will love it. It's George Gammon /pro. And I will see you on the next video.